Okay, so hi everyone. Welcome to today's webinar. Because we are already midway to December of 2023, right? I have closed off my trading book for the year. And for this particular year, Nimbus Capital, we managed to achieve an ROI of 80%. In fact, actually much higher because in the last 2 days, we closed off some trades. Okay, so this is a webinar to mainly go through some of the high profile, okay, I wouldn't really say high profile, but certain significant trades that we took this year and how we spot them and what is our overall trading framework, trading philosophy and strategy that we use now, okay? And it is so that when you are going into year 2024, you really seriously want to pick up trading and you want to be on the right path, it is a guideline that you can follow. So if you are new here, you have no idea who we are, you just happen by this link somewhere, I don't know where, okay? It is a huge honor of that you are choosing to spend your Saturday night with me, like some stranger on the internet. So I really appreciate that. And for my usual audience, right, of course, a huge thank you for being like continuously supportive, support of me, okay? So without any delay, right, let's begin. If not, we may end up here for like until midnight like that, because the PowerPoint that I have is actually quite long. There are over 50 slides, but I'll try to make it interesting and I will like move fast now, okay? So if you have any questions, right, write them down somewhere. And then at the end of the presentation, right, there will be a like 10-minute for Q&A or I'll be here until like everybody managed to get their question answered, okay? And because this webinar is like for the public as well, it is not my community, right? The chat is being turned off, okay? So you can't do any public chatting here, okay? So that we can like sort of focus. I don't want the chat suddenly overwhelmed with a lot of questions. Okay, so let's begin. So firstly, of course, disclaimer, every financial webinar, trading related webinar, we need disclaimer now. Okay, so now we are only covering the stock market. Hey, sorry, can you all hear me? If you all can hear me, please reply to me. Say yes, someone. Okay, thank you. Okay, so if you can't hear, please fix your mic, okay? Or sorry, please fix your speaker. Okay, so we are only covering the stock market, mainly the US market. We will not be covering Hong Kong, Singapore market or the Forex market. So if you are a Forex trader, then maybe a lot of things here might not apply to you. And our main instrument for trading is options. And when options are unavailable or unattractive, we will trade stocks. Our trading framework only apply to the US market. So whatever strategy that you are using, right, it is not to say that you cannot apply to Hong Kong or China or Singapore stock. It is just that the kind of information, the kind of data that we need, right, is not readily available for the China market or even the Singapore market, okay? So US market is quite friendly in terms of the amount of data provided. You can go to any website, you can download things like the non-farm payroll, the unemployment rate, the inflation numbers, the retail sales, all this kind of stuff. You can actually get them on the internet. And especially for stocks related stuff, also like your earnings report, all these kind of stuff, right? You can get it very easily from the like public website. But when it comes to Hong Kong and China, and even for Singapore, right, if you want to dig certain information, it's quite hard, okay? So for our trading framework, it is easy to apply to the US market. But if you want to apply outside of US market, it's a little bit hard. Then again, right, you wouldn't really be trading much outside of the US market also, I believe. And our framework is for trading only. So it's not for long-term investment. If you are going for like 20 years, 30 years investment, of course, your strategy will be very different. And Of course, past result is not indicative of future performance. So this is something that is always there, okay? So don't have to elaborate much on that. So now, before we go through how we trade and our strategy, right? Let's discuss a bit on the limitation with the current trading strategy out there. So most trading strategy, be it like investment funds, mutual funds, unit trusts, or even your CPF investment, right? They are what we call beta funds, and they achieve beta return. So beta funds follow the movement of the benchmark. So the benchmark can be S&P 500 or various MSCI World Index, those kind of stuff, okay? But when we talk about benchmark, it is usually the S&P 500, very simple. And they attempt to outperform the benchmark. So if the market is rallying, they will try to gain more returns than the market. Or if the market is crashing, like in 2022, when the entire market crashed pretty hard, what they will do is they will try to lose less than the market. So in either cases, right, they are so-called outperforming the market. So at the end of the day, right, the thing is that they follow the benchmark relatively close. So if you look at any prospectus, any fact sheets of unit trusts, any investment funds out there, right, you will see that they will plot their return against a benchmark, and you can see they track the benchmark very, very closely. So most strategy attempt to catch the trend of the benchmark. So most funds that are available to retailer like ETF, like SPY ETF, STI ETF, or your CPF, or unit trust, or any kinds of funds out there, they are long only funds. There are no short position in those funds. So as such, right, most funds, they barely outperform the benchmark. And in some cases, right, they kind of like underperform it. So it's actually quite bad. So retailer strategy, right, when it comes to retail trading, retailer strategy are similar, as they will attempt to catch the market trend via various indicators, technical indicators, screeners, or I don't know, okay? I don't know what the retail traders are doing. So retailer try to outperform the market through leverage instruments such as CFDs. So if we look at majority of the retailer performance from a volatility or risk-adjusted return or a Sharpe ratio perspective, right, they severely underperform. So to cut the story short, right, beta funds and retail trading strategies, they are at the mercy of the market direction and the volatility. If S&P goes up, your portfolio goes up. If S&P goes down, your portfolio goes down. So now let's take a look at an example of a portfolio. So this is a very simple portfolio, a 8-position portfolio. Very diversified. In fact, I will rate this portfolio like 7 out of 10. Okay, you can see that it's very, very well diversified. You have Apple, Amazon, Tesla, Microsoft, Nvidia, Occidental Petroleum, Visa, United Health. So it is quite diversified across different sectors. You even have a defensive counter, which is United Health, and then you have financial in Visa, and there's exposure to energy stock also from Occidental Petroleum. And then in terms of technology, you have the hardware and the software, which is Microsoft, Apple, and Nvidia. And on top of which there is internet retail, which is Amazon. So if you look at this portfolio, right, it is a very, very good portfolio, but there is something wrong with this portfolio. And the thing is that the entire portfolio is a long position portfolio. So on the furthest right-hand side of the table, right, you will see the beta value. This is the beta value of the stock. And then if I were to take the average beta value of the entire portfolio, it is somewhere around 1.34. So as long as your portfolio beta value is above 1, it signifies that your portfolio is actually following the S&P 500 or the benchmark very, very closely. You cannot escape the market movement. You cannot escape the volatility of the market. Wherever the S&P 500 goes, your portfolio will follow. So now from here, right, you will start to kind of like wonder a bit, like, okay, if I am like choosing all this stock, and then at the end of the day, if my portfolio performance is actually very close to the performance of the S&P 500, right, then why on earth should I spend so much time trying to pick certain stocks when like your effort is actually wasted at the end of the day? You might as well just invest in S&P 500. So that is usually one of the questions that we have. And in fact, a lot of retail traders out there, right, they choose to trade the S&P 500 index instead of actually picking stock. And it's usually stemmed from this particular behavior of stock picking, because no matter what stock you pick, at the end of the day, you are still outperformed by the S&P 500. And in fact, right, this phenomenon is very well documented. So now, the Warren Buffett challenge. So let's sidetrack a bit into this particular challenge set off by Warren Buffett. So I'm sure you all should be very familiar with this. A lot of retail traders love to like reference to this particular challenge. And in fact, a few days ago, as I was scrolling through my Facebook, one of Adam's cool advertisement actually pops up on my on my Facebook newsfeed, and I was reading through his sponsored post for his trading course, and then that post itself, he made reference to this Warren Buffett challenge. So for those who have no idea what this is, or if you need a small refresher, right? In 2008, Warren Buffett challenged the hedge fund industry, which in his view, right, he feels that the very, very high fee that hedge fund charges like is not really that good in terms of the hedge fund performance. The performance is so low that he feels that these hedge funds, right, they shouldn't be charging so much when at the end of the day, right, most of the hedge funds could not beat the S&P 500 also. So Warren Buffett believed that an S&P 500 index fund will outperform a hand-picked portfolio of a hedge fund. Hence, we have this whole argument of passive investing and trading philosophies. So a hedge fund called the Protege Partner LLC accepted Warren Buffett challenge. And then they were like, okay, I'll take up your challenge. We are a hedge fund. We can definitely beat the S&P 500. But unfortunately, right, at the end of the day, that hedge fund actually lost, Protege Partner actually lost, because over the next 8 years, for some, I don't know what's the reason, Protege Partner only returned 22% over the next 8 years. You have to wonder what kind of hedge fund is that to return 8% over 22 years. I think if you invested in CPF special account, you probably make more, okay? Because 4% times 8 is 32% return. So I'm not sure what this hedge fund is doing. But Buffett Index Fund, which is the S&P 500 Vanguard, actually returned 85%, which is not bad, not bad. I mean, over 8 years, you return 85%, right? It is about 10% annualized. So this challenge led many retailers to believe that hedge fund managers they are all scammer, okay? They are all scammer, like anyhow charge so much, make themselves so exclusive, but like can't even beat the S&P 500. And then a lot of retailers also believe that hedge fund strategies are not worth pursuing. What for I spend so much time learn macroeconomics? What for I go and learn fundamentals? What for I go and take a financial degree? When at the end of the day, I can simply just invest in S&P 500. So retailers love to reference this challenge because they actually now have proof. They have the justification to simply follow and trade the index. And in fact, many gurus, a lot of trading gurus out there love to use this story to simplify their trading system and products. And of course, retailers love this kind of products. Like whenever you see an advertisement that say, oh, you can earn this much profit with less than 10 minutes of analysis. Who doesn't want? Who doesn't want? Who doesn't want to spend like 10 minutes in a week to get some profit? I mean, everybody would want that. I mean, it's like the best thing ever. Then the the funny thing is that as I was researching this particular challenge, right, the details of the trade which the protege partner LLC took, right, they were not disclosed. Very conveniently, they were not disclosed. This is mainly due to SEC rules on hedge fund marketings, okay? So when come to regulation, right, hedge funds, they are highly regulated on how they can solicit capital for their trading activities. And one of the restrictions is that they are not allowed to reveal their portfolio as some kind of a marketing tool, okay? So because of that, right, that there's no way I am able to find out what sort of trade this hedge fund is taking that they only return 22% over 8 years. Excuse me. So ironically, this whole challenge was actually a great marketing success for Warren Buffett, Berkshire Hathaway, because in fact, his company is actually a listed company. It will invite a lot of shareholders. It will invite a lot of people to buy up the stock of Berkshire. And what is even more ironic is that we all know Warren Buffett is a very successful investor, and the reason why Berkshire is able to consistently outperform S&P 500, right? It is actually due to smart stock picking. So I'm not sure what Warren Buffett is trying to achieve, but I mean, you can take away whatever you want from this whole challenge, okay? So just want to share this particular piece of history. So now you can get this information from investopedia.com. I have put up the source over there. So the index fund is Warren Buffett funds, the fund that he used for his challenge. And then we have the protege, sorry, I can't pronounce all these French words, okay? Protege Partner LLC only returned 22%, which is actually an average of 5 different funds, okay? So as I mentioned, right, you really have to sit down and think whether if this hedge fund is deliberately trying to lose to get 22% in 8 years, they might as well throw all their money in our CPS special fund. They can return more than 22% already. So now at the end of the day, right, there is a very, very important question here, and I think it's something that you should think about also. We should not anyhow just go and take all these kind of story for granted, at least dig a bit. And the main question here that I want to really ask is the performance of protege partner, this 22% over 8 years, can it speak for all the hedge funds out there? Every single hedge fund out there, is it representative or not? And my answer, and I think it is also quite obvious that the answer is actually no, because there are so many hedge funds that you don't even know their name that are performing very, very well. In fact, well beyond whatever Warren Buffett index is performing. So now there is a reason why we are going through this, and it's quite important because the truly profitable hedge funds out there, right? Those that are truly outperforming the benchmark, they actually have no reason nor the incentive to be participating in Buffett's challenge, mainly because hedge funds don't need advertisement, they don't need exposure. They cannot solicit fund from public like suka like that. And because of that, right, there's no need for them to be like up on the stage challenging, doing all this kind of challenge. For example, right, a very, very famous popular hedge fund, Renaissance Technology, they actually have 66% annualized return for the past 30 years, meaning over 30 years, they actually have like 3,000, sorry, my maths fail. I think over 1,800% return over the past 30 years, which is performing very well beyond any benchmark index out there. And the less popular one, also known as the Caxton Associate LP, the fund posted 13% gain in 2008 and 2009. So you may be wondering, 13% within like 2 years is like, it's not a lot, but you have to understand that 2008 and 2009 was the great financial crash where the entire stock market dropped like 70-80%. and actually their customer withdraw 20% of their total asset. But despite that, right, they are able to post a 13% gain. Imagine you are a bank and you suddenly lose 27% of your total capital, but at the end of the day, right, you are still able to gain 13% on top of that capital that are being withdrawn. So that is actually a very respectable achievement. And in 2010, this fund returned 12.8 billion on a 6 billion account. So effectively more than 100% return. And in 2020, very recently, during the COVID year, the fund made 40% return and they are actually no longer accepting any new money. Okay, so most hedge funds that are massively profitable, right? They do not bother with this kind of publicity stunts such as the Warren Buffett challenge. And in fact, there are many internal documents and guidelines on what sorts of activities the fund can participate in. Because the only reason why you want to put yourself out there is for exposure, is for in order to get people to know about your fund so that you can solicit more fund. But the thing is that hedge funds, they have certain regulation on how they can actually solicit funds. So such participation, right, it also requires shareholders and director approval. So most hedge funds just don't care, okay? So at the end of the day, right, forgive my language, the true profitable hedge fund do not participate in dick measuring contests. They are just doing their own thing. Most hedge funds, they tend to close their fund to investor once certain milestones are achieved, mainly because a few reasons. Firstly, they want to avoid dilution of existing investor shareholding. If you have a lesser capital, right, you can have better risk management and control over what you are actually investing or trading in. And profits are not diluted because if you have a bigger fund, then you actually require a high level of diversification, which is actually not a good thing also. And lastly, it is to maintain exclusivity. Okay, let's say if you are the founding member or if you are the main investor of a particular hedge fund and that hedge fund is doing very well, right? You don't really want other investor to come in because they will dilute your shareholding. They will dilute they will actually dilute your returns. So most retailers are outside of the universe that hedge funds operate in, and you don't really hear about successful hedge fund, just like you don't hear about a private jet broker pitching you their latest Gulfstream model, because we are not there, okay? We are simply just not there. We are living in a different universe. So now, why are we covering so much about hedge funds? Because as I mentioned, right, it is very important. And it is very important that we understand how hedge funds actually trade. For example, if you look at Renaissance Technology performance, how is this particular hedge fund getting 66% annualized over the past 30 years? That is a very consistent and very high return. So the true way to get absolute return, so when we say absolute return, we are referring to non-beta return, which means your portfolio performance do not care about market condition. Whether market trending up, trending down, doesn't matter. We don't care. In order to get that kind of non-beta return, right, you need to trade like a hedge fund. And that is how they get those kind of crazy returns. And it is not through scalping, swing trading, day trading, wave trading, candlestick trading. I don't know what trading now. Now got astrology trading ready if you want to believe in that. But whatever trading that retailers are calling now, okay? These terms, right, they are actually created for retailer, so brokerages can sell you their product. It's easier for them to package their product and their strategy so that you will use their services. And there's nothing more profitable for retail brokerage than a bunch of retail traders forming big communities and sharing these strategies among one another. Trading guru community culture that we have right now, right, is actually massively profitable for brokerages. If you look at Tiger and Mumu brokerage, the application, right, they actually have a very big forum where trader can actually like share what they are trading. They have like their own Twitter, okay? They can share their returns, they can share what is their idea. So they know, this brokerage know the potential of having this community under them. So if you Google hedge funds trading strategy, right, what you will not see is that you will not see things like scalping, swing trading, day trading, all those kind of stuff lah. In fact, right, if you go and look up hedge fund trading strategy on Investopedia, you will not see all these terms also. So if you walk into a hedge fund interview, let's say you are lucky enough to get accepted into a hedge fund interview, right? And you go there and tell them I'm a swing trader, you will be out of the door without even getting an interview, okay? So one day, if you are lucky enough, please don't embarrass yourself. don't say you're a swing trader. So you will only find those terms on brokerage website aimed at retailers and gurus and influencers who are employed by said brokerages. Okay, so I did a quick Google search on hedge fund trading strategy, and these are what you will actually get: global macro strategy, directional hedge funds, relative arbitrage strategy, capital structure strategy, and the long short strategy. So now I have specifically highlighted long short strategy because that is what we are using, and that is what majority of the hedge fund out there are using also. And in fact, it is one of the most popular and the most used strategies in hedge funds. So you can actually Google this, but you will not really find a lot of information on this, mainly because no retail guru is teaching this lah. You will never go into a guru course and you will learn this because this is actually being used by those hedge funds that we don't really hear from. Okay, so now trade like a hedge fund. So it is important to understand how hedge funds operate differently from index funds and ETF and unit trusts. Hedge funds seek to make risk-adjusted absolute return by maintaining a beta and delta neutral portfolio. So just now, when I show you the example of a very standard portfolio, right, you can see that the beta average of that portfolio is actually 1 point something. But most hedge fund portfolio, they have a neutral beta, meaning the beta is somewhere around 0 lah, okay? And that is how they are able to outperform the market without really caring where the market is going. Because when you are beta neutral, you become independent from what the market is doing. And that is how we get risk-adjusted return. So how do hedge funds achieve that? They achieve that by managing a long-short portfolio. So this is the long-short strategy that we have shared just now. So it is a portfolio that consists of both long and short position. The and is very important because hedge fund does not long when market trending up. They don't short when market is trending down. At all time, regardless of wherever the market is trending, they have both long and short position on certain stocks that they believe will outperform or underperform. So the fund is always beta hedge for stocks or delta hedge for options, because for option, they have different terms, okay? So stocks are chosen based on fundamental and macro factors, not technical. So this is the next big difference. Hedge funds do not buy stock because it broke the resistance or it bounced off the support. They don't gather at a lunch table and then start discussing which stock is bouncing off the support or which is crossing the 20 days moving average. They don't care about those. But the stocks are chosen primarily based on fundamental and macro factors. So now it is a common misconception for retailer to believe that fundamental are for long-term investors, technical are for short-term investors. And this is actually very, very wrong. In fact, we will show some examples later. There are fundamental analysis method for trading and different fundamental analysis method for long-term investing, okay? So we do have different kinds of FA out there. So now to give you a very raw, vague example, what I have here is two stocks. The name are censored so that you cannot look up what is the stock price right now. So we have stock A and stock B. if you look at the technical on these two stock, right, they are somewhat similar. They are coming down from the top, and then they are bouncing off the support level. They are bouncing off the previous support level. So you can see like here, there's a support level here, bouncing off, support level here, bouncing off. And in fact, it dipped below the support level a bit, okay? So most retail trader like to call this stock hunt lah, the big boys trying to take out your stop loss, all those kind of stuff lah, okay? So whether or not you believe those, up to you lah, okay? But nonetheless, you can see the structure, the chart pattern is somewhat similar. And you could also see that during the point where I cut off, you can see the price kind of recovering. The price is poking through above the 2 moving average. You can see the MACD going above the 0 line, the RSI recovering. Same thing for stock B also. MACD going above the 0 line, the RSI recovering. So now, these two stock, one of them will gain like 100% in the future. The other stock will crash like crazy. But at this point in time, and you can also see that the date is somewhat similar, okay? One is on the 27th Jan, the other one is on the 23rd Jan. So this chart is I have taken a snapshot of this chart at a very similar date, okay? So one of them will rally very, very high. The other one of them will crash very, very low. And in fact, for those folks with sharp eyes, you probably can tell which one, okay? And it is not from technical. It is not from technical. It is from something else. So now I'll give you guys about 1 minute. So based on what you can see here, right? Which stock do you think is the one that rally? And which stock do you think is the one that crash? And type out your reason. I'll give you 1 minute. Okay, you are typing directly to me. So I will see how many choose which one. I'm gonna drink my Milo for 1 minute. Lai, don't be shy. Okay, we got a few sharp eye people already. we got a few sharp eye people already. I think those who are in my community will very obviously know what stock A is lah, okay? You definitely traded that. You definitely traded that in January, if you can still remember. Okay, let's continue. So of course, here, right, we are looking at the stock in the past lah, okay? So we can definitely tell what the price is like in the future. But let's see what's going on here, okay? So now, the reason why I'm pointing this out is that imagine yourself back in January. You are sitting down in January 2023. You are looking at this two chart, and if you are just looking at it purely based on technical, right? Maybe you may not want to long this, or maybe you may even want to short this because it is like a downtrend and it is like hitting the resistance level and then it like want to U-turn back down like that. But if we look at it from momentum perspective, it also seems like it want to break out, it want to rally like that. So from technical, right, you can't really make sense like much on which stock will rally, which stock will crash. No, it's not. It's not Siri. It's not Siri. Okay. Hey, Siri very cheap, leh. Siri is like $3. You know, in January, Siri is like $2 like that. Yeah, some of you got the stock already. So yeah, so now from technical perspective, you can't really tell. But in fact, I can tell you at this point in time, right? If you were to study the fundamentals of either one of the stock, right, you can somewhat with good confidence tell which one will rally, which one will crash. So let's see. Now, this is stock A. Stock A is of course Palantir. Okay. So now Palantir, if you look at the first purple line, the first purple line is the line that I drew just now, okay? So everything that you see beyond the first purple line, right, is how the stock performed. And the second purple line is actually is the line that we took profit, if I'm not wrong. We actually got this trade back then. But what you can see is that you see this letter E here, this E here. This E means earnings. On this date, the earning report for Palantir was released, and the day after, on the day that the earning release, right, the stock actually gap up. In fact, from the point where we identified until that point in February, right, the stock actually rallied 44%. Because this chart is being zoomed out, right, you can't really tell that this movement here is a big rally, but in fact it is. It moved up 44% in less than 2 weeks, which is crazy. It's a crazy amount of movement. And in fact, right until now, Palantir have gained over 180% now, okay, in somewhere around August like that. It went up super duper crazy. And the reason being that during this earning, right, they actually became profitable. For a very, very long time, Palantir was actually a loss-making stock, loss-making company. And on 16 February, when they released their financial earning for the last quarter, right, they actually became profitable. So when a stock goes from loss-making to a profitable state, the market tend to buy up this stock because, I mean, the stock is now profitable. And if you want to know an example of a very famous stock that also went in this kind of direction, you can actually look at Tesla. You can look at when did Tesla became profitable and look at how much did the stock went up. Palantir followed the same. And now let's look at stock B. So now stock B is same thing. This first purple line is the purple line that I mentioned. And you can see this little E here, which is the earnings. When the earnings came out, stock B, which is Plug Power, they were losing money, they were burning money, they are losing customer, losing contract left and right, and the stock actually went down. Okay, so you can see two different outcomes of two different stocks. But at one point in time, right, the technical were basically the same for both of them. So as a trader, how do you know which stock to buy, which stock to short? You cannot simply just look at technicals. So now, I've given you a very surface level example, okay? So let's go through Nimbus Capital trading philosophy, our trading mandate. So all trades are chosen based on fundamental factors such as earning expectation, growth initiative, presence of a near-term catalyst, macroeconomic tailwinds, etc. So only with sufficient fundamental backing and the presence of catalysts, then we will apply technical analysis on the stock. Meaning to say that we do not choose a stock based on technical. We choose a stock based on fundamental and macroeconomics. Once we have chosen the stock, then we will look at technical to see whether we can enter or not. So obviously with the technical just now, we entered long position on Palantir, but we don't really care about Plug Power, okay? Plug Power is just a control example. So our holding time frame is 2 weeks to 8 weeks. And during this period, right, there must be a catalyst present. At all times, our portfolio contain both long and short position, okay? The and is very important, not all, okay? So this allows us to achieve a beta neutral portfolio whose performance is independent from the benchmark. We don't care where the market is heading. We don't care S&P rallying or crashing or whatever. We don't care. We just ensure that our portfolio contains long and short position. So we maintain 8 position portfolio with varying degree of bias. So sometimes we will structure a 4 long, 4 short, which is a neutral portfolio. If we are bullish, we have 5 long, 3 short. If we are bearish, we have 5 short, 3 longs. And sometimes we can exceed our 8 position. If there are opportunity present, why not? We take 9 position, 10 position. No one's stopping us now, okay? It is just a rough guideline. Or if we foresee closing off some of the position in the near future, right, we will temporarily take like 10 position like that lah. Eventually in the future, maybe 2 position will close off and then we are back to 8 position. At any point in time, we do not risk more than 20% of our current total portfolio. So thus far, for the entire of 2023, we barely crossed 10% drawdown. Okay, so our drawdown is actually half of our tolerance. So we trade what we think is going to happen in the next 3 months. We don't trade what is happening now, meaning to say we hardly chase the trend, but of course sometimes we will chase the trend at some point, but most of the time we are actually looking ahead in the next 3 months. So big movement in stock are always driven by fundamental. You see Palantir went up 100%, 180%. That movement is driven by fundamentals. So being ignorant of the fundamental driver, right, it does not equate to your technical analysis work. Yes, you may blindly buy a stock because the moving average crossover for or whatever, but the reason why those moving averages are crossing over, right, is because at the back end there is a macro driver or a fundamental driver. It is just that you are not aware of it, but something is happening. So if you can project fundamentals and macro drivers, you will be in position before the herd does. And most of the time, like we are bottom catching. In fact, we bottom caught a lot of trades that did very well. And you'll be cashing out when the herd is frantically FOMOing into position because finally the technical is showing that they can enter. Okay, so this is like a rough example of how we manage our portfolio. So if we are bearish, right, we have 5 short and 3 long. If we are bullish, we have 5 long and 3 short. If we have no idea what's going on, then we maintain a neutral portfolio. And we can actually switch between our bias by replacing only one position. So if I am in a net short bias, I want to go into a neutral bias or a neutral portfolio. I just need to replace one short with one long, then I'm neutral already. I don't need to replace my entire portfolio. Okay, so now with all those said, right, let's go into our 2023 portfolio performance. Hopefully I can cover this within like the next 30 minutes, hopefully. Okay, so now this is our overall report card. Let's go through a few things. Okay, there are a total of 154 closed trade, but bear in mind that in reality the actual number is a lot lower, mainly for one simple reason. For those who are familiar with options, you will probably know why. Because whenever we take certain option structure, right, for example like a vertical structure or a calendar structure, diagonal structure, you actually take 2 trades together, one long and one short with different strike price. So a lot of our trades are actually coming in pairs, one long and one short. So the actual number of trades that we took, right, is you can divide this by 2, which is somewhere around like 77 like that. Okay, so yes, we trade somewhere around 77. We have 77 trade ideas for the year 2023 lah, or very close to that number. So now of this 154 close trades, 86 were winning, 68 were losing. So our winning rate is about 55.84%. I mean, it's all right. It's all right. In fact, a lot of hedge fund portfolio, their winning rate is around there also. So currently I have 11 trades open. So if you look at this, that 11 trade is in the US market. Currently we have 11 trades open, but yesterday, right, we closed off some already lah, okay? But this PowerPoint was done like around Wednesday like that. So you can also see that our position is 7 bullish position and 4 bearish positions. So obviously currently we are of bullish bias, but at the same time we still hold short position. Okay, so now our median trade duration is 17 days and our average trade duration is 25 days. So these are calendar days, okay, meaning we cover weekend, it also cover non-trading days, those kind of stuff lah. But the reason why I'm displaying median and average is very important, because your average trade duration, right, it can actually get skewed by certain outlier trades. For example, right, there are 1 or 2 trades that I actually hold for over 100 days. And because I held that one trade for over 100 days, right, the average value gets skewed upwards, even though 90% of all my other trades are somewhere around 17 days, 15 days like that. So sometimes it also makes sense to look at median instead of average. Okay, so you can see we are not investors. We are using fundamentals, but we are not investors. Our trade close out very, very fast. And in fact, later you'll see most of our trade close within a month or sometimes less than 10 days. So our starting capital for this year is 125,000 USD. The total profit is about 300K. Total loss is about 193K. So we net about 105K in profit, which is currently standing at 84% ROI and a Sharpe ratio of 3.21. But we have closed out some trade yesterday. So because of that, right, actually our ROI right now is somewhere around 98%. We are very close to 100%. So let's go a little deeper. Yes, for the entire of this year, we only traded US stock. Sorry, there should be a US here. All 154 trades are coming from US. And you can see 65 of those trades are bullish trades, 79 of those trades are bearish trades, and 10 of those trades are agnostic trades. So agnostic trades are trades that we have no idea where is it going. It can go up or it can go down. We don't know. But we take a position that we can benefit from either direction. But what we want is volatility. We want the trade to move. We don't care where it moves, but we want it to move. So those are agnostic trades. And you can see here the days, the duration of our trades. We have 41 trades that close within 10 days, which is about 26%. We have majority of the trade close within 10 to 30 days, which is about 39%. And we have a number of trades that close from 30 to 60 days. Okay. So if you recall our time frame, 2 weeks to 8 weeks, right? It's actually 2 weeks to 2 months. Okay. So we actually have more than 90% of our trade that close within our framework, which what we consider trading time frame. So of course there are 10 trades that close beyond 60 days. Okay. So analytic by win-loss, we have our win-loss ratio for bullish trade is a lot higher. That is quite obvious because the market right now is very bullish. Year 2023 is actually quite bullish towards the second half. So it's obvious that we will profit more from our bullish trade. Okay. Bearish trade, we actually have more bearish trade, but we have a lot of losing bearish trade also. Yes, we make some losses on the bearish trade, but the reason why these trades are important is that if the market crash this year, which we have no idea at the beginning of the year, all these trades will actually be in profit. Okay, so this is covering our ass. These are hedging. And of course, agnostic trade, we actually lose more than we make profit, but these are like a very insignificant amount. So we have no Hong Kong or Singapore trade this year, only US. So we have more win than loss. Okay. And in terms of duration, you can see we are winning across, we win more than we lose across all duration. But the one with the highest winning ratio is actually less than 10 days. And the second highest winning ratio is about 30 to 60 days. And then those that are more than 60 days, right? We actually win most of them also. Okay. So it's important to review your trades. Because let's say you are holding your trades beyond 60 days and all your trade within this time frame are losing trade, right? Then you might as well don't hold. What for you hold, right? So this kind of analytic is very important. Okay, so now this is something I want to share regarding my equity curve also. So during the beginning of the year, right, the first 3 months, you can actually see that I wasn't performing well at all. In fact, in January and February, I was loss making. Okay, so the red line is where I start, and I was basically loss making all the way until March, and then it was only until April when I start to do quite okay, and then loss making again, and then after that, my portfolio picks off. So this is also to show you that we cannot be profitable every week, every day, every month, every quarter. We survive three entire months with losses, but it is important that you sort of maintain your emotions, make sure you are just following your trading system, whatever lah. Okay, so it is to say that we do have a bad month lah. Okay, we do have bad month, a bad quarter, and that is very, very common even in the professional world. So now you can also see towards the end of the year, right, the profit picks off. And this is also very common, is very common in a sense that as our portfolio gain in capital, right? So somewhere around June like that, our portfolio hit 150K. So once our portfolio hit certain milestone, right, we will actually increase our lot sizing because we can actually afford a higher risk tolerance. So we can increase our lot sizing, which will make our portfolio go up more, which means we can increase our lot sizing even more. So there's a compounding effect in play, okay? So it is very often, it is quite common for a typical portfolio to be in this kind of like a exponential curve like that. Of course, if you draw this equity curve in a logarithmic scale, right, then it will be a straight line. Okay, so now as portfolio managers, we want to achieve a portfolio that is close to beta neutral. Slight biasness is fine, but and it is encouraged, but we do not want a portfolio that have a very high beta value. We want our performance to be independent from the market. So if you have a beta neutral portfolio, you essentially have a non-beta return where you don't care where your benchmark is heading. Okay, so first quarter of 2023. Let's take a look. These are all the trades that we have taken in first quarter of 2023. We have a lot of stuff going here, and you can actually see a few things here. This one should not be here. Tesla should not be here because it was closed on the last day of 2022, but unfortunately it's there lah. Okay, so but what you will see in the first quarter, right, is that I have a lot of bearish position. We started off Q1 with a very, very bearish sentiment, but obviously we were wrong. In fact, Q1 was actually quite bullish. So you actually see that we start off the year making quite a number of losses now, okay? But there are some trades that I want to highlight. So now these trades, right, it is ranked according to the exit date. So if I exit within the first quarter, right, it will be within the first quarter, okay? So it is not ranked by my entry date, but rather by my exit date. So now, a few trades that you want to pay attention to. You can see Palantir here. So obviously this Palantir is the trade that I shared just now. And there's Home Depot here also. So if you see symbols, if you see the format like this, right, it means this position is an option position. So this is the stock symbol. This is the option expiration. C is call, P is put, and this is the strike price, okay? So you can see majority of our trades are actually stock positions. And you can see here the losses and the gain that we make. So one thing that will definitely jump out is that at no point we lose more than 3%. Okay, our loss are actually limit to 2%, 2 point something percent. And then of course, somewhere down the road, we actually made 10% profit on Home Depot. So now let's look at in details of what's going on. So Q1 2023, we actually started the year on the wrong foot. A lot of things were not really going great. So 2023 started off with S&P 500 at the near low. Inflation was at 6.5%, and Federal Reserve is still on the narrative of higher for longer rates. They are going to hold at this high for this long. They are not discussing about rate cuts, blah, blah, blah. A lot of the word pain has been used by Jerome Powell a lot. So obviously we were very bearish now, okay, as we go into 2023. So we projected that inflation, we projected inflation to rebound and the rates, the federal fund rate to go much higher. So our portfolio was bearish bias, but still beta neutral, okay? Bearish bias, but still beta neutral with a 5 short, 3 long position. Of course, we are not always 5 short, 3 long 100% of the time. New position get entered, old position get exited, but most of the time we are maintaining this ratio. So market relatively went bullish for the first quarter. We underestimate the spending power of consumer even in a high rate environment. So now our trade performance, we actually lost 15K on 6 short position. We actually shorted Netflix, Carnival Cruise, FXI. FXI is China index, okay? China index fund, China large cap. And then VIX, we didn't short VIX, we actually long VIX, but long VIX is a bearish position, okay? We shorted CarMax, we shorted Louisiana Call. All of this trade actually we lost. We lost about 15K, but we made 12K from one of our shop, which is Home Depot. So the reason being is that we foresee a decline in earning due to lesser spending on home improvement product. Because the federal fund rate is very high, the mortgage rates are very high, which means there will be lesser home purchases, meaning to say lesser home improvement spending. So we kind of feel that, okay, Home Depot probably will bomb the earning, bomb as in they will miss their earnings, okay? And in fact, Home Depot did miss their earning and we were able to get 12K on the short position. And we made 8K on what we consider a hedging trade, which is a bullish position. So we are bearish, but we do have long position, which are considered hedging position. And in this case, Palantir was a hedging position. So now, why did we pick Palantir? Because despite very high rates, right, Palantir actually have a very strong revenue growth. Their revenue growth is still relatively strong, mainly because most of their revenue is coming from government sectors. Okay, the government sector doesn't care inflation, doesn't care whatever. They need money, they print money. Okay, so and in fact, Palantir was very, very close to being profitable. They are just like a few million off only. As long as they can reduce the cost somewhere, they can actually become profitable. So we projected Palantir to be in net profit on the first quarter of 2023 after a prolonged period of loss making. And if inflation start to ease, right, and if Federal Reserve is switching their narrative to dovish, then Palantir could actually rally quite significantly. And in fact, Palantir did reported being profitable in the first quarter of 2023, and then the stock shot up. So we have shared that just now. So first quarter, although we were wrong in our portfolio bias, right? The long short portfolio and the beta nature of a hedge fund trading strategy actually allow us to squeeze out a 3K, a net profit of 3K in the first quarter of 2023. So if you consider a 125,000 USD portfolio, 3K profit is almost nothing, okay? But at least even though our direction is wrong, we still managed to squeeze out something. And during the entire period, our portfolio volatility remained very low. At no point we were holding on to losses more than 10% of our capital, even with like a 8-10 position. So now this is Palantir. We have shared the purple line is our entry date. And you can see we were basically bottom picking this. Why? Because we know the earning is just a few weeks away. So we entered somewhere around late Jan. And then on 10th of February, earning came out, the stock shot up. And this whole movement is about 44% like that. And of course, right now it is like very, very high. And this is Home Depot. Home Depot at the time we enter was this purple color line. And then the earning came out here, which was a few weeks down the road. And you can see during the earning, the stock just gapped all the way down. And then we hold a little longer and then we took profit. So our entry is somewhere around like 325. We exited somewhere around 20. So it is about, I don't know, maybe 10-15% drop within like also 2-3 weeks period. Okay. So now if you are a technical trader, right? And if you are waiting for this support to break, it actually break during the earning. And when the earning came out, right? The stock already like massively gapped down already. If you only short here, there's not much meat for you already. And your risk is very, very high. So most of the time, right, we actually defy a lot of technical stuff. We just, okay, earnings coming out soon. This is bearish. Let's go. Usually we are doing that kind of stuff. Okay, so now this is to show you the Palantir earnings. Okay, so Palantir during Q1, right? During the January that we entered and February, the earning came out, right? That February earning is actually for Q4 22. So you can see that in Q4 22, their net income actually become positive. Previously, they were losing 100 million, they were losing 179 million, they were losing 123 million. And suddenly, one fine quarter, they actually made 30 million profit, positive. And in fact, they remain positive beyond that. And that's why you see Palantir is still rallying like crazy right now. So we are able to spot all these trades through fundamental analysis, through macroeconomic analysis. Okay, so now Q2. So now Q2, we have a lot more trades, a bunch of trades here. One difference is that you can see a lot more bullish position, but there are still some bearish position. Okay, but you can see it is like quite equal. The number of bullish position and bearish position actually quite equal. So let's go through some of the highlight trades because there's too much stuff already. And some of the trade was held for 80, one trade held for 80 days. Okay, so now this trade, Celsius Holding, CELH, it is one of our first big profit for the year. And the next one is STX. STX is Seagate. And CRS, the profit not a lot, but it is good to cover this stock also. CRS is Carpenter Technology. And these are the stuff that I want to focus on now. Okay, so now we hit Q2 of 2023. And the funny thing is that when we reach Q2, right, we were actually still very clueless. Because when you get Q1 wrong, right, you have no, you are a bit of like, huh, what's going on? So when we hit Q2, we were a bit clueless. So continuing from Q1, right, we were a little befuddled with certain macro data. Okay, like we have no idea what's going on. So job market was relatively strong despite the higher rate. The unemployment rate was like 3.5, 3.4. It wasn't like it wasn't spiking up. Okay, this means that consumers are still earning sizable income to actually pay for stuff. They still have that disposable income coming in. And inflation actually fell from 6% to 3%, which was like I have no idea what's going on there also. Okay, but we do see data and we kind of like, okay, inflation is falling right now. And market was resilient on the back of falling inflation and strong labor market. And there was a talk of possible soft landing. So while we want to increase our bullish bias, right, because all these are actually bullish signal. Okay, so our Q1 we were bearish bias. So with all this signal data coming in, right, we want to increase our bullish bias compared to Q1, but we are also aware of the risk of high rates. Okay, because at that time Federal Reserve is still raising rates. They are still talking about they are still mentioning things like pain. We are not thinking about cutting rate, those kind of stuff. Okay, so we want to be careful. We do not want to go like overly bullish. So what happened was we opted for a neutral portfolio. So in our mandate, right, if we have no idea what's going on, you go for a neutral portfolio. You will never lose. You will never lose with a neutral portfolio. It's just that you may earn less. So our trading performance. So our biggest win year to date was a long position on Celsius Holding. CELH is a sports drink company. So why did we went long on this? It's because Celsius signed a partnership with Pepsi, and they are going to leverage on Pepsi distribution network, which will greatly increase the sales of Celsius Holding drink. And in fact, these two drink company partnering up together is like it's a very strong move for both of them. So we believe that this partnership, right, this growth, it will materialize and it will reflected in the first quarter 2023 earning released on May 23rd. And Celsius Holding, it rallied more than 100% since the earning report. So the next trade, we also have significant profit on a short position. So we are winning on both long and the short. It doesn't mean that your long win, meaning your short must lose. Sometimes you can win on both ends. So we have a profit on short position on Seagate. So now Seagate was actually quite a simple short because Seagate, they have very bad cash flow and they also have very cash position and they have negative equity. Negative equity is a bad thing, it's a bad situation to be in, okay? And the sales and net profit was declining, and we believe that this high interest rate environment, right, it will make things even worse for Seagate. So we have a short position on it. So Seagate declined 20% within 2 months, and it actually went down 10% on earnings day alone. And we have a modest profit on Carpenter Tech, which is CRS. So Carpenter Tech is very dear to us because it was spotted as an example during our trading course. So during Q2, right, we have our trading course now, okay? So during trading course, I will usually try to spot a live trade, and we spotted CRS, but the fundamental on CRS was so good that we were like, okay, I think we can actually take this trade live. we don't need it as an example. We are going to take this trade live. So the company actually have a huge backlog of order from airline companies. And this is because Carpenter Tech manufactures specialized metal alloy for aircraft, especially aircraft engines. So it's a very specialized, very niche business with a niche customer. And airline sector actually recovered to pre-COVID level, and a lot of airline companies, right, they are actually facing delays on their new aircraft deliveries because Boeing and Airbus, right, they were not able to meet all these delivery numbers because they are missing materials suddenly like the market is flooded because now everybody is traveling. So Carpenter Tech was actually drowning with a lot of orders. So the stock was up. The stock went up 60% since we spotted it. So although our portfolio was neutral with equal number of short and long position, right, we were confident in the quality of our trades. So our winner outperformed significantly compared to our loser. So we ended Q2 with additional 23K in profit. So now this is Celsius Holding, a little bit messy, but you can see this is from their website. Okay, from their website, they were announcing the partnership with PepsiCo, powerful alliance, strengthened penetration with new and existing customers channel because now Celsius Holding is leveraging on PepsiCo distribution channels. Actually, Pepsi is a much bigger company than Celsius, and Pepsi delivery channels are a lot more there's a lot more exposure to what Celsius back then they have. So it is definitely a big advantage for Celsius Holding for this particular partnership. And you can see here for Q1, Q2, and Q3, right? Celsius Holding revenue, the first line is the revenue, okay? You can see the growth is like 98%, 100%, 104%. And if you look at the bottom line, which is the net income, the income actually went up 480%. Now you have to ask yourself, with the interest rate at 4%, 4.5% at that point in time, where can you find a company that can actually make 480% earning growth, 100% sales growth? You do not see this level of growth in this kind of environment. And that was how we actually spotted Celsius Holding. Okay, so now the purple line is where we entered, and you can see when earnings came out, gap up, earnings came out, gap up, because they are gaining massive sales growth from this partnership. And at the top right, Celsius Holding gained 122%. But we actually went out, we actually take profit midway, okay? But still, 44% within less than 2 months is definitely a very strong return. Next, Seagate. So now Seagate, a totally different story. You can see it's already trending down. So so if you want to look at it from a technical perspective, right, we short at the resistance now, okay? The purple line is the line that we shorted. You can see the earning date, the stock gap down about 10% like that. Currently it has recovered lah, okay? Currently it has recovered, but back then we were able to capture this downside due to this earning catalyst lah. Okay, so you can see for Seagate, right? It's a total different story. Revenue declining. Net profit declined by 644%. And it's already loss-making, okay? They're already loss-making. So you can also see their balance sheet, right? The total equity went down by 1,200%. Negative equity. I have no idea what's going on there. Okay, I have no idea how are they surviving now also. But back then, with a very bad fundamental, burning cash, negative equity, this rebound, right? We took this rebound as an opportunity to short. Lastly, Carpenter Tech. So as I mentioned, right, Carpenter Tech, they have very strong backlog, up 10%, and it's actually up 155% from last year, which is like crazy. The demand is led by aerospace and defense end-use market as the entire aerospace industry supply chain ramped to meet the current OEM build rate. So not only that, right, we actually look through things like a lot of airline companies, and a lot of airline companies are doing very bad because all their airplane orders are not coming in. Boeing and Airbus, they are kind of like the supply chain gets stuck there lah. And Carpenter Tech is actually one of the few companies that provide all this material for aircraft manufacturing. So the purple line is where we entered. And since then, right, it has went up about 64%. But of course, we exited somewhere like here lah, okay? Around here, we didn't hold the whole way because we are traders, we are not investors. You want to invest in this, also up to you, but we want to get out once we got the spike lah, okay? Once that earnings spike come in, right, we want to zao already. We go and play other stuff. Okay, so Q3, hopefully you are not bored yet. So Q3, a bunch of trade here, but one trade was stand out. One trade immediately stand out. For those in my community, you should know also lah. Okay, Siri. This is our very first trade in this year that made over 20K. 20K. Of course, it's not one trade, it's two trade. But it's on the same stock lah. Okay. We have two trade here because we add on to our winning position. So we made 21K on that one trade alone. And you can see here, this is the trade that we held 115 days. So why did we hold 115 days? Later you will know. And we also have a string of losses from Scorpio Tanker and Sun Country Air. And we have another big win on CCJ. So I'll go through CCJ later also. And First Solar, we also have some losses on First Solar. So these are the highlight trades lah. Okay, the rest of the stuff are like not here, not there, not here, not there. So Q3, rising yield. So Q3 is actually a very straightforward quarter. In fact, Q3 was the quarter which like we were very confident on our fundamentals and macro views lah. So inflation rebound. Inflation dropped to inflation dropped to 3%. And then it rebounded back to 3.7%. So this pushed the US 10-year yield significantly higher because now Federal Reserve is like, oh my God, inflation going up. We have to hold higher for longer. We are not thinking about cutting rates. So Powell keep repeating the same thing. Okay, but right now we actually have data to sort of back his statement because inflation suddenly spike up. So market seems to be buying into Federal Reserve trap, and a lot of yield-sensitive sectors, such as home builder, right? They actually start to decline from their high. So our portfolio switched from neutral to slightly bearish bias with a 4 short, 3 long structure. Okay, it's not 5 short, but we have 4 short, mainly because we don't want to be overly bearish also. So it's like a little bit bearish, So our next year-to-date biggest win came from SiriusXM. So SiriusXM is a satellite radio company. So you'll be wondering how come we are trading a satellite radio company. In fact, recently Warren Buffett entered. Okay, Warren Buffett entered quite a big position to SiriusXM. but we actually entered in March, so we are ahead of Warren Buffett lah. Not to blow our own horn, but we are ahead. So this was actually a pure mechanical trade, meaning to say we are not actually looking at fundamentals, but we were looking at something else. We are aiming for a short squeeze. Okay, we were aiming for a short squeeze because this company has 30% of their floating shares shorted, which is like almost 1/3. And the day to cover ratio is 10 days, meaning to say if a short squeeze were to happen, the current liquidity would take the entire market 10 days to recover all the shorts, meaning to say there's not enough liquidity in the current market for the shorties to cover. So we entered this trade way back in March. And when we entered the trade in March, right, our intention was very clear. Our intention is that we will hold until the short squeeze occur. Doesn't matter how long it takes. Can be 3 months, 6 months, 7 months, 8 months, 1 year. We don't care. As long as it takes, we are going to hold this. So because of this special requirement, right, we actually risk very little. We risk very little, much lesser than our usual risk. But the thing is that if this trade were to goes in our direction, our profit is actually 7 to 10 fold, okay, about 7 to 10 fold. So quite a significant profit if it were to happen. And on 20th July 23rd, the short squeeze occurred and the stock actually went up 43% in a single day. In fact, some of our community members were awake at 3 a.m. in the morning because this stock shooting up and we were like, oh my God, like we need to take profit, but we can't take profit because the stock was getting halted. It was halted because like the movement was unusual. And we also took a couple of losses from oil sensitive trades such as Scorpio Tanker and Sun Country Airline. We expected oil price to continue to decline, but inflation rebound, oil price rebound, and then these two trades didn't go well. So we took losses on both of the trades. We also suffered loss on TLT. So TLT is a US Treasury bond ETF, okay? So when we took this trade, right, we hope that the yield will drop because inflation is at 3%. But surprisingly, inflation rebound. And because inflation rebound, right, the yield also rebound, which means the bond prices start to go down. So our TLT suffer a loss. And during this same period, we were also bullish on clean energy stocks due to the Inflation Control Act. So we were long Chemical, CCJ, which is a uranium mining company for nuclear energy. And we were also long First Solar, which is the biggest solar manufacturer in US. So we hit a home run with CCJ, but we suffer a small loss on First Solar. So due to the rising yield, right, we also shorted a home builder stock called MDC Holding in the third quarter. But however, right, the profit from this trade, right, it only materialized in the fourth quarter. So the third quarter, our trading performance for third quarter was kind of like a bit weird because majority of the profit were coming from bullish position, even though our portfolio was bearish bias. So this further emphasized the importance of maintaining a long short because you never know where your profit is coming from. So a beta delta neutral portfolio is very important, and that is how you outperform the market. You want to be winning profit from things that are not following the market. Also to note, the short position that we have taken in the third quarter, right, they only start to move during the fourth quarter. So we close off the quarter with a net profit of 31K. And at that point in time, we were up about 55K on a 125K account. So very close to 50% return rate. So this is Sirius XM. So you can see here, some of us were up at 2 a.m., around very close to 3 a.m. We were talking about, oh my God, the stock is being hotter, we can't exit, blah, blah, blah. And you can see where the short squeeze happened, okay? So our first entry is on the 24th March. And we entered another position somewhere around here, a second position. And you can see where the short squeeze happened on the 20th July. It went up 42% in a single day. So from our initial entry, right, this stock went up 100%. And we actually held the entire direction, the entire duration. So the other two trade, Sun Country Airline, SNCY, it was triggered by the drop lah, okay, the drop in the price. It was triggered by rising oil price and inflation. And TLT, also same thing. It was triggered by rising yield, which is the result of which is the result of inflation rebounding lah. So both actually dropped. In fact, Sun Country Airline, right, we were actually in some profit before it start to U-turn lah. So we were able to recognize the why when our trade fails and the fundamental driver behind the downward movement. So because of that, right, we are able to limit our loss and we keep our loss small instead of like trying to average down lah or doing all kind of funny stuff lah. So this is Chemical and First Solar. So Chemical was entered on the first purple line. We entered another entry on the second purple line. And then we exited somewhere around $40. But the stock actually went up higher all the way until 46. Unfortunately for First Solar, it went the other direction. So our first entry is on the 6th of July. Initially made profit, but the second trade ended up in a loss. So overall, it was a loss. But we won more profit in Chemical than the loss that we made on First Solar. Okay, the last one, fourth quarter. So fourth quarter, not a lot of trades because we still have a lot that we haven't closed up. But you can see a few things here. The profit are much larger. And this is mainly because as our portfolio capital grows, right, our risk also grows lah, okay? So as we hit 200K or as we hit 175K, we increase our risk. So these two trade, THO and MDC, right? These are the bearish trade that we took in September, mid-September, and then they were exited somewhere around October. And then of course we have Disney, we have Victoria's Secret, TLT, and we also have Shake Shack that we recently just closed up. So now quarter four was also quite straightforward. Peak yield, the yield have peaked. Another straightforward quarter. The 10-year yield continued to rise to 5% in October. This caused numerous yield sensitive stock to drop, the home builder stock, which we shorted. And suddenly in November, right, the narrative changed because the inflation fall back to 3.2 all the way from 3.7. And then the 10-year yield start to decline. And we correctly predicted that the October 5%, right, that will be the top. The 10-year yield will not go higher than 5% already after the inflation numbers came out. So we immediately trim our short position in November, and then we adopt a bullish buyer's portfolio with 5 long, 3 short. And with this development, right, and last week, this week, we also have Federal Reserve, the last FOMC meeting, and FOMC, the Jerome Powell, they also have mentioned that they are planning rate cut next year already lah. So everything that we projected for Q4 somewhat was in our direction. So now our trade performance in October, we profited massively from 2 short positions on yield sensitive stock. Thor Industry, not Marvel Avengers, is THO. But it's Thor lah, okay. It's a RV manufacturer, recreational vehicle. The other one is MDC Holding, a home builder. So during October, when the yield went up to 5%, right, all this stock was falling left and right because home builders are very interest rate sensitive. If mortgage rates are very high, right, nobody is going to buy new homes lah, okay. So this position will enter mid-September on rising yield and exited in October. So during the same time that we shorted Thor and MDC, we also had long position on 2 consumer discretionary stock, Shake Shack and Disney. So these 2 were entered as a hedge against possibility of declining yield. And in fact, yield did decline, and thankfully, we already cashed out the shorts. But at the same time, we are able to turn our hedging trade into a directional trade. So 3 days before earnings, we also projected Victoria's Secret to rally regardless of whatever the earning result is, mainly because the reason behind this rally will be that the macro drivers from lower inflation and lower yield, right, it will equate to higher consumer spending, because a lower yield meaning your mortgage rates are coming down. If your mortgage rate from 3K per month drop to 2K per month, right, then you can buy more lingerie, okay? So that's basically the idea behind it. So the earning day will just act as a catalyst. So Victoria's Secret actually rallied 33% in 1 week after our entry. So TLT, we also have a TLT trade again, was a straightforward trade because as inflation came back down to 3.2%, right? We projected 10-year yield should peak at 5%. It should not go beyond 5% already, and it should start declining. And as such, right, TLT was one of the very, very obvious play. So TLT rallied 14%. So 4Q 2023 was our best performing quarter as the direction was clear and we have multiple high conviction trade. So we profited 55K in 4Q alone, which bring our year to date to 110K on a 125K account. So this is MDC holding. The purple line is our entry. We managed to get out right before this big rally. So you can see both MDC and Tor holding, right? They are very similar. They are both very yield sensitive. And the moment inflation came down, you can see how the stock actually just rebound. Okay, so this reversal in the stock is not because close the gap the rebound support or whatever okay? There is a fundamental driver behind it. But we were able to capture this downside here. And Shake Shack, we entered Shake Shack right at the bottom here. And then currently it is up about 28%. We just exited this yesterday. And Disney we entered like here, 10th of October. And we entered another position on 28. Currently it is somewhere around here, okay? So our second position is currently in like break even like that. Our first position already profited quite big from this rally here. And you can also see it is a earning gap up. Okay. And Victoria's Secret, we entered 3 days before the earnings. And after the earning came out, the stock just shot all the way up 34%. And this is TLT. TLT is also very straightforward. The moment we saw the inflation number, we went in ready, and then TLT just shoot up because the yields are declining. So when you decline, right, bond goes up. Okay, so all these trades that we have shared, I've shared with you right now, they are actually also shared in our Patreon, our Discord channel, okay, our private Discord channel. You can see all the familiar names over there. We share all our trades on Discord for our paid Patreon subscribers. Paid subscriber also have access to our weekly webinar and our market outlook and my portfolio position, which is updated every weekly. So we do not treat this service as a signal provider, and in fact, we highly discourage blind copy trading by people who only want to take shortcut, okay? Traders who think like they spend 5 minutes push button, they think can become profitable already. We don't want this kind of people. So our aim is for serious trader to engage in our thought process, our reading and understanding of macroeconomic data, and how we actually manage this long-short portfolio. Because if you have not heard of long-short portfolio strategy before, it will be very new to you, and managing it takes a bit of life experience. You need to see it happening live. There's no PowerPoint out there that can teach you how to do that. So what we are sharing here, what we are doing here is something that no trading course will be able to teach you. Okay, so summary for 2023. Much like 2022, right? 2023 was an inflation sensitive year. Everything moved around inflation expectation, like your Federal Reserve policy, the yield, the stock market, everything, okay? Everything is moving based on how the inflation number is. So we got the macro direction wrong for the first quarter. We started the year with losing streak, but managed to recapture profit on our hedging trades. Second quarter was a little hard to project from a macroeconomic perspective. We stayed neutral. We simply long companies with good growth. We short companies that were burning money. Is as simple as that. But of course, the hard part is identifying those companies. So Q3 and Q4 were straightforward. We managed to profit from our high conviction trade. We were able to catch the bottom when the market U-turned. The market actually U-turned somewhere around early November. So that was that period where we exit most of our short. We restructure into a long bias. In fact, some of our hedging trade became directional trades. So we believe market will remain bullish as December FOMC suggests rate cut in 2024. At the same time, the job market remain very stable. Unemployment rate is still below 4%. So yields are coming down and it will ease some pressure off the consumer. Okay, lower interest rate on floating mortgages, meaning those mortgagee, those mortgage payer, they finally will have a little bit of like some breathing room. Okay. However, right, we have to be aware of other things that is ongoing. The activities in manufacturing and service sector, right, they are slowed down quite significantly. Okay, so it is not really a good sign. While Federal Reserve may hint of rate cut in the future, right, can the economy continue to tolerate the current 5.5% federal fund rate for the next 3 or 6 months? So when is Federal Reserve going to cut rates? Is it in like second half of 2024? So can this current economy survive until that second half? That is still a question mark. So I will not be surprised if later Q1 of 2024, right, suddenly market crash and then you want to be prepared for that kind of situation. So the risks are still present, hence, right, we must manage our portfolio volatility via long and short management and beta delta hedging. You do not want to be in a position where you have 10 long position in your portfolio because everything bullish and then suddenly everything hits stop loss because suddenly the market U-turn. We actually faced that in January of 2022. So in January 2022, right, we went in with like 8 long position and suddenly all 8 long position were like cut off because the market suddenly crashed. So general tips to become a profitable stock trader. Sorry, a bit small because a lot of points here. Firstly, do not take shortcut. Be honest with yourself. Okay, you will know when you are you can lie to everyone, but don't lie to yourself. Okay, so you should know when you are taking shortcuts. For example, copy trading. You go and anyhow copy while someone posts the TP stop loss level, you just copy. You don't do anything. Blindly following people. Using screener and scanner, which criteria are unknown to you. Somebody sell you a screener and say it's a proprietary secret, so you just blindly use that screener, but you have no idea what the screener is doing. You just think that you press the button, profit fall from the sky. So that kind of mindset definitely will not make you become profitable trader. And index trading, right? Index trading make it impossible to hedge and get non-beta return. Because when you trade an index, you will be at the mercy of the index. So in order to get non-beta absolute return, right, you must learn how to pick stock. You must learn how to trade stock. If you are dollar cost averaging in an index, it is as a long-term investment plan, right? That's fine. That's fine. That's actually a good idea. You can do that. But for trading, if you want to get good result from trading, you must learn to pick stocks. And you must also learn to pick stock aside from the popular one. Don't every day Apple, AMD, Amazon, Nvidia, Tesla, like very boring, super duper boring. And those stocks, right, those popular stocks, they are part of the market. They are part of the index. You can't beat the index if you are trading components of the index. So if you recall, majority of the stocks that we shared just now, only some of them are familiar to you. Shake Shack, Disney, probably you may know those. Home Depot, but Celsius Holding, have you heard of it before? MDC Holding, Tor Industry, Sirius XM, the one that got short squeeze. So you need to learn how to pick all these stocks. And the funny thing is that for a lot of traders, right, they are scared of unfamiliar names. And the reason why they are scared of unfamiliar name is that they are fearful of the unknown. They don't know how to do proper analysis. And if you do know how to do proper fundamental analysis, right, then you will stay away from all this stuff when there's actually a lot of gold mine out there that's waiting for you to go and dig. So learn the proper fundamental and macroeconomic analysis, because all stock movements are driven by fundamentals and macro. Things like GDP, the bond market, federal fund rate, inflation, PMI reports, go and learn what are those. Earnings growth, sales growth, earning multiple, sales multiple. These are very important fundamental factors. Understand what macro drive what stock. Certain macro will drive certain sector. Sometimes you see all the oil and gas rallying. Sometimes you see all the EV stock rallying. Sometimes you see all the airline stock rallying. Try to understand what drive what sector. Understand what is volatility, standard deviation, Sharpe ratio, beta hedging, delta hedging, risk adjusted return. Go and learn all these terms and learn how to calculate these. You may end up learning an entire Excel. You learn how to use Excel. It will be painful, it will be hard, but you need to learn those skills. So using leverage to get outsized return is actually bad because that return is not risk adjusted. It does not alter the volatility of the asset that you are trading. So if you do not understand this, right, if you do not understand this sentence, it's very important that you try to understand it by researching on all this stuff. Simple technical analysis such as moving average, MACD, RSI is actually sufficient. You don't need to go and pay for some secret indicators. Learn to use option properly. If all you know is selling OTM puts for free premium, then you got a lot of work to do, okay? That is not using option properly. That is a shortcut that some guru taught you, okay? So the reason is that option provide better control, better risk management, and better risk reward ratio than stock if you use it properly. So do not scalp with leverage. It's not worth it for stock market, okay? One winning trade that made 30% gain is better than trying to get 30 winning trade with 1% gain each. So now think bigger. Always try to think bigger. You should be asking things like, where is the economy heading? What is the 10-year yield doing? You should not be asking like, TP where? Enter what price? What's the MACD setting? So you should not be asking those until you got the bigger picture. Take the top-down approach. Macro, fundamental, and then technical. So now put in the time, clocks in, treat trading like a part-time job that you need to clock in. If you're only spending 30 minutes a week, right, blindly following trade signal, right, then you have to ask yourself honestly if that is sufficient to be profitable. Obviously not. If you spend 30 minutes a week, right, there's no way you can get 100%, 80% return, okay? I personally put in about 30 to 40 hours a week. But of course, I'm doing this full time, so I can do that. But even for a part-time trader, right, you can squeeze out 10 hours. You can squeeze out 10 hours. And that is the amount of time that you need to learn things properly. Okay, so be a part of our community. We have a lot of staff program. But sadly, our 3-month trading course, right, our August batch is just graduated, and we currently have no plan to conduct any course because we are actually working on a big project. Unfortunately, unless you have attended our course before, right, the only way for you to learn our trading framework is through the one-to-one coaching service. So this is our one-to-one coaching service. You can find more information on nimbuscapital.info. So what is it? It is 6 months of intense one-to-one coaching. You will learn proper trading framework of what I've mentioned. You will learn how to generate quality trade ideas. You will trade and manage a portfolio in a live market. Okay, within this 6 months, you are going to be actually trading, and I'll be there, okay? I'll be there to guide you. So requirement, what is required of you? Huge time commitment, approximately 10 to 15 hours per week. And there's a lot of self-reading and homework, okay? So if you are interested, you need to be able to put in this amount of time. you are also required to be a responsible, disciplined, and independent adult, because I give you homework, you don't hand it, I'm not going to chase you like school kid like that, okay? You don't hand it, I take it as you are not serious. Okay. So if you want to come for this service, right, you need a minimum of USD 50,000 available for trading. So this is not the fee, this is your own money that you need to have for trading, because the reason is very simple. At the end of 6 months, right, I want you to have sizable profit. Okay, I want you to have sizable profit. I don't want you to come to this program with 10K and then you spend 40 hour, 50 hour during the entire program. And then after that, you only earn like 1K, 2K profit, which is not worth it. So that there's a minimum trading capital you need, okay? And disclaimer, this service is not for me to provide you trade signal. If you do not put in the required effort, you may not see profit at the end of 6 months. So if you do not do your homework, right, or you are obviously doing bare minimum, then don't expect success, okay? So this is mainly for the super duper serious people. And you can also join our much more economic, our Patreon and Discord. So you can actually go to patreon.com Nimbus Capital. You can be a paid membership. Currently is USD $20 per month, but it will be USD 25 per month in February. Okay, so you have access to all these trade setup, trade okay, I don't want to use the word signal. Okay, trade ideas, weekly webinar, Discord, this Discord chat channels, just come in, chill, chit chat. We also share our portfolio in our Discord channel. Okay, so these are currently the service that we are providing right now if you are interested. So thank you for staying through. If you are still here, we are going to almost 11. I'm so sorry. I tend to overshoot okay, because I like to share a lot of stuff So Q&A session. If you have any question with regards to the presentation, please feel free to ask them. You can type in the chat box. I will look at the chat box and I will answer you. So I'm going to take a quick 2-minute toilet break, okay? And then I'll come back and see if there's any questions. If not, then we will end this session. Thank you very much, guys. Okay, I got some questions. So let's see. Hey bro, thanks for the very informative session. Thank you. I got two questions. If you would please, how those stock that you traded pop up on your radar in the first place before you decide to dig in for FA? Okay, it's very simple. In fact, I'm gonna reveal something to you. I'm gonna reveal trade secret to you. Okay, so we actually have our own scanner, but our scanner is not proprietary, secret, or whatever nonsense now. Okay, I actually subscribe to Quifin and Refinitiv. So from these two service, right, these two products, you can actually do some screening. So instead of screening for technical factors, right, we actually screen for fundamentals. Okay, we actually screen for fundamentals. So you can see this quant data here. You can see the screen is massive. Okay, it's massive. It's seriously massive. Like sometimes when I open this up, my computer lag. Okay, so what we do is we will look at a lot of fundamentals factor such as what was their earning, what is their like profit margin, that kind of stuff and then of course the exact things that we are looking at is for our cost members they pay the money, they come for the course, so we can't reveal that okay, so that part is proprietary. But the screener itself, right, you can actually get it from places like Quifin. Do you think current philosophy will still work when the fund size is bigger? Okay, now when your fund size is bigger, this is a very good question. For example, let's say if I have $1 million account, right? I cannot trade 8 position. If I have $1 million account, I probably need like 12 position, 13 position, or maybe 15 position, or even 20 position, because you cannot throw a bunch of like you cannot have so much increase in exposure on one single stock. Okay, so as your fund size increase, right, you actually need to do more hedging, you need to do more diversification, and as the number of position grows, right, you actually require more effort, more time to go and pick out those additional stocks. And that's why a fund size of like $1 billion, those actual hedge funds, right, they have multiple analysts in order to help out with that obviously one person cannot manage. You really need a lot of quants and a lot of analysts to do all the back end work. So definitely, if your fund is bigger, more effort is required on your end. But of course, if you have $1 million portfolio, you go and hire hire a few people to do all the grunt work because managing a portfolio, right? Managing a long short portfolio is very different from choosing a stock. It's not like you choose a stock and then you go and like, oh, can enter it. It's not like that. You can actually hire people to choose the stock for you. You go and teach them. Okay, I'm looking for this. You go and help me find all this information. You go and ask them to do those. And then once they get back to you with a list of shortlisted stock, you can go through their report, and then after that, you decide, okay, I can take this, I can take that. Oh, I got too many shot already. I cannot take that shot, that kind of stuff. Thank you. Very, very good question. Very good question. Okay, I'm gonna hold for another 5 more minutes. So if by 11:05, if no more questions, then I will be ending these sessions Once again, thanks everyone for attending, especially the new folks, because it's really like, I mean, to take out 2-3 hours of your time to come here, right? Is I treasure your presence here. back to the question just now. Just so we don't have awkward silence now, okay? So I actually do know people with $1 million, 2 million, 3 million, 4 million account doing the same thing. Like they are trading the same way, a long short strategy, and they are actually retired hedge fund traders lah. And usually their portfolio is like they have twice the position that I have. They are actually managing like 20 position, which is a little bit crazy because I don't know where they find their time to go and look up so many stocks, because even as a full-time trader right now, I simply cannot like squeeze in so much time to go and dig out 20 different stocks. And considering that we are closing off position every 30 days, right? Every 30 days you need a fresh pair of 20 stocks ready to go, which is like what? Final 2 minutes. Any more questions? Any questions? Not anymore. Any questions? I'm just gonna look at the stock market while waiting for people to waiting for people to ask. Yesterday was option expiration, so you can see there's a sudden burst of volume coming in for all the option expiration. So if you are someone who do volume analysis, you have to be mindful of these. These are not selling climax, stopping volume, all those kind of stuff lah. Okay, it's just the option expiry. Okay, before I end, right, for the new folks, I assume you are on our Discord lah, okay? So I will be uploading this video under the public channels okay? So it will be under here, this particular thread, 80% ROI for 20. So I'll upload the recording here lah, okay? So you can, the actual Zoom link is here also. But of course, if you are not a Patreon subscriber, right, then all the remaining channels are not visible to you lah. But if you subscribe to our Patreon, then you will get access to all these channels. Okay, guys, it's 11:05, so I'll be ending this session. Once again, thank you very much for attending, and hope to see you guys in our Discord, be it public or private or whatever lah. Okay, I'll try to share as much as I can, as long as I'm free lah. But there's like even though I'm not scalping, there's actually a lot of work have to be done trying to pick stocks. So time is always not, there's never enough time lah. There's never enough time. Okay, guys, have a great weekend and have a great December. Hopefully, with the market at all-time high right now, very close to all-time high. I do hope that whoever trading for this whole year, hopefully you get a very, very good return as well. So have a good night. Bye bye.